Hello, everybody, and welcome to the March Lerner Group discussion meeting. I'm Michael Schneider. I'm joined today by J.R. Gondeck and David Sokolovsky. And a few of the topics we wanted to go through today are the Fed. We had Jerome Powell come out and raise interest rates yesterday. And we also want to discuss some of the other economic data that has been coming out that's been, we'd say, probably more towards the positive side of things. Then also look at what's been going on in the markets, kind of talk about what we've seen so far this year and just more or less opportunities that we see moving forward. So with that in mind, JR, do you mind talking about the Fed for a little bit?
Yeah, we've been talking about this and the markets have been waiting for many months, and it finally happened yesterday. So the Fed has been very vocal about increasing rates really since the end of November, and it happened yesterday. So it was interesting to see the commentary from the Federal Reserve. I mean, their main concern, as we've been talking about, is inflation, right? Inflation continues to be very high, well above, I mean, we're at 40-year highs across the board. So it was just a 25 basis point increase, as we thought they would probably do. And then on top of it, they hinted to 6 more rate hikes ahead. So a total of 7 is kind of what's forecasted in the marketplace. And when you looked at the overall statement and kind of what was there, I think many people would have expected maybe the markets to be flat to down. And really you saw the opposite. So I think a lot of people are wondering, why did the market go up? So let's just stop there and maybe ponder some of the theories there. David, why'd the market go up?
Yeah, it seemed like a little bit of a sigh of relief. Earlier in the year, we were expecting a higher increase in terms of interest rates, and really that was part of the thinking behind holding off until being more aggressive in March. But you see that generally the economic data has been pretty positive, and I think Powell's commentary, not only about the amount of the increase, but about the strength of the economy has really given investors a little bit more confidence.
And then on top of it, I think there's the old saying in the markets, buy on the rumor and sell on the news. Here, it maybe was the opposite in a lot of ways. We've been talking about this, that we were patient till the middle of March has been our thinking really as we came into the year. So maybe it was more of a scenario of sell on the rumor and buy on the news, because you just saw a lot of activity to the upside, because there continues to be a lot of cash overhang, obviously, with the world events that are going on that have kept a lot of cash on the sidelines as well. But, maybe that was part of the scenario. And to your point, I think reiterating that Chairman Powell does not see a recession anytime soon, I think is another good reason that you saw a lot of buying.
And would you say that this is any type of sort of calm before the storm, that you could see markets start to teeter a little bit if we do see more interest rate hikes?
Well, let's pull up the interest rate graph overall, because I think it is a question on many people's minds, on top of the worry of a slowdown and stagflation. And if you look at the interest rate graph here, you have 2 lines. The blue line is kind of how the yield curve from short-term to long-term interest rates looked to start the year. And then the orange graph, or the top graph, is now. And what you notice is the orange line is dramatically higher than the blue line, which all that tells us is interest rates, whether it's short-term or long-term, have all risen a lot already this year. And the Fed just raised 25 basis points yesterday. And the other thing that's interesting, Michael, maybe on your concern, is that flattening on the top graph. If you look at the blue graph, it was pretty steep all the way from short-term to long-term. When you look at the orange graph specifically, and a lot of focus is usually on the 2-year interest rate, the 10-year, that might be a little bit of an ominous sign of something to watch for, because a flattening or an inverted yield curve is historically a bad sign. But for now, it's still relatively steep on the yield curve overall. And when you look at some of the other data, let's talk about inflation specifically, because that was the #1 concern of Powell and really the Fed the last 3 or 4 months. I mean, CPI last week, year over year, was 7.9%. I mean, that's a huge increase. I mean, 40-year high. PPI, producer prices, were double digits. Is there any reason, Michael, at all to be cautiously optimistic with some of the data and inflation?
I would say yes. And the reason for that is when you look at the month-over-month numbers as of late, up until the most recent numbers, the actual numbers that came in have always been higher than the surveys, if not equal to them. But you look at the PPI number, it was actually, the actual number was lower than the surveyed number, and from CPI, it came in line. So when you look at those types of trends, it's at least a positive sign that maybe we're getting closer to peak levels of inflation, and that at some point, some of these numbers should start to normalize and taper and sort of level themselves off.
And then after inflation specifically on prices, we have employment and wages, and we look at that, David, I think some thoughts around what we're seeing in the labor market might be interesting as well.
Yeah, well, there's really two things to look at. One is the size of the labor force, and we've seen that the number of people who are actively looking for work or working is going up. So the civilian labor force has increased and brought back about 1.7 million jobs just since the end of last year. So for the first 2 months of the year where there's data. And in line with that, you're also seeing better than expected unemployment numbers. So more people returning to work, less people losing jobs. And the level of wage growth, I think, has leveled off. And we've seen that come through in some of the data, but also anecdotally with a lot of the families that we work with. This is the first time in a long time that we're hearing that their team is fully staffed and they have all of the people they need to kind of do the work that they need to get done. So we might see some of that wage inflation. Sure, the number went up and has established kind of a new base, but we've seen that level of wage inflation maybe slow down and taper off for the time being.
And with the wage inflation, that's unique here too, is there's a lot of concern with inflation eating away at savings and spending and such. But what's interesting with this, and maybe minimum wage is a good example, where the federal minimum wage was in the $7 range. Over half the states, and some prior to this year, went to $15 minimum wage. In percentage increase, it's 100% increase. So on middle and low income or starter salaries overall, there's been a major increase, which has probably helped mitigate some of the consumer spending concerns over the high inflation as well. So it's something to watch for as we look ahead. So with that, if we look now maybe at the returns so far this year and maybe some overall trends, as we're preparing for this, it was interesting to see what's happened since the Russia attacked Ukraine in late February. And, as we were looking at this, we were surprised to see that the markets are actually higher than that event, right? Even though they're lower for the overall year. So as we look at the year-to-date numbers, it's interesting to look at that. So Michael, maybe we want to highlight some of the trends we're seeing.
For sure. So, pretty much across the board, the big difference has been that the growth categories have been lower on the year, but more of your value companies, your high dividend stocks, those have been more or less flat to up. And you look at the different sectors, as you see on this chart on the right of the S&P 500 different sectors, the only area that's up this year has been energy. Everything else has been has fallen lower. And so when you're looking at how have portfolios been performing, or how have allocations changed, a lot of this ties back to what we were talking about last year. In a rising interest rate environment, it's going to be more difficult for growth companies to maintain their valuations. So you would see a rotation more towards the high value companies, high dividend companies, and that's really what we've seen so far this year. And when you look at some of the higher level indices, you have NASDAQ stocks down, roughly 20%. S&P is down about 10% as well. And when you look at the broader, makeup of those components, again, you see the growth areas that have performed much worse than the value stocks within those different indices.
So if we stop there for a second and think about, as we gather, we're halfway through March now. As we looked at the expectations for the year, right, I think most people had forecasted maybe a single mid-digit return, having had 3 strong years back to back to back. And as we thought about the Fed raising rates, this doesn't really surprise us that the markets have been negative to this point. So now as we look ahead, I think stop for a second, and a lot of concern over the spike of oil, right? It has been on a lot of people's mind, because when you look historically and the huge increase in energy, if we go back and confirm or compare to 2008, maybe is the last time we saw a major spike in oil prices, and just look at maybe some of the actions we've done and maybe compare the two eras. So in 2008, here's just a chart of oil prices and the underlying energy companies. And what you'll see in here is that oil prices peaked, call it in July of 2008. But by that point, oil stocks had already started to fall. But then we saw a big recession follow in 2008 into 2009. So there's a lot of concern, right? And oil at the time went from $100 to $150 a barrel when it finally kind of peaked down. So if you take a step back and maybe look at what was the economy like in 2008 when that happened, and if you go back during that period of time, there were months and months of job losses ahead of the spike in oil prices. Housing prices were falling. We were already slowing growth. There were credit conditions. I mean, at the time you had a lot of people underwater on their houses, right? Mortgages were a big problem. And then you had the huge spike in oil. And at the time, the US was a net importer of oil, right? Versus today. So if you look today, we've had a similar spike in oil prices to 130 this time or a little bit more. But look at the fundamentals of the economy this time around. We are creating jobs month over. It's probably been a year and a half straight of job increases. You have wages up and you continue to have pretty good conditions. The equity homeowners are sitting on collectively has never been better in the history of America. So there's reason to believe this time around, as you look at the spike of oil, it is going to be different. But again, we're all mindful of consumer spending trends to make sure that continues. But it feels a little bit different. So as we think about that, it's pretty much 2 years to the day on the lockdown initially of COVID. So David, maybe let's recap on the 2 year period, which I think to many of us feels like 20 or longer. How do we, what are some actions, or how does the behavioral nature of investors, and what do we do?
Yeah. So thinking back to 2 years ago, just putting yourself in that position when we're hearing about lockdowns coming to the US for the first time in history, right? That at least that we're during our lifetimes. And how does the market change overall? So, our approach was, I think, a little bit different than most, and that's what gave us some success in 2020. But you saw that as the markets were winding down, there was companies that held up pretty well. So if you think about, large retailers that, were very well stocked, and people were rushing to stock up on all of the things that were disappearing from our shelves, toilet paper included, in March of 2020. So once those stocks held up, and they held up pretty well, we started looking for opportunity and really finding names of companies that have strong financial positions that were poised to really weather the storm. And in many cases that turned out to be, for example, restaurants and other companies. So we saw those do particularly well because they were beat up. And the question was, how are these companies going to survive if everything is shut down, right? They were able to innovate and pivot. And so during that time, we shifted a little bit to restaurants and other areas of opportunity. But if you kind of look at where we are today, you would have seen that, as oil is going up, most people probably aren't selling along the way up. And that's a behavioral finance component where you're following the herd and the trend. And so you have this recency bias, right? If oil went up last week and the week before, it's probably going to go up this week and next week. And so at that point, we started lightening up a little bit and really shifting to the experience economy. So we're seeing air travel reaching record numbers in terms of where it was after COVID. We're seeing transportation and other areas as well. So it's shifting to those areas of opportunity because the things that have held up, they've done great. And that's where we're taking some of the gains. And now as we look to reposition, those are some of the companies that we're targeting. But if you take a look over the last 2 years, any of the popular tech stocks that you would have seen, and you would have seen the astronomical performance from the start of COVID. So teleconferencing technologies, entertainment at home, all of these different things. In many cases right now, they're trading below where they were in 2020, right? So they had a very rapid rise and then a very quick return to levels at least as lower than 2020. So that's kind of the shift that we've seen.
Yeah, when you look at the opportunities that are out there, it's again, when you look at the behavioral nature, a lot of people, and the general is to chase, as you said, David, what's kind of hot at the time. Whereas if you stay patient and look a little longer term, that's where kind of doing the opposite or doing kind of away from what everybody else is doing tends to work out pretty well. And it continues to be the case as we look to maybe a different aspect of what's out there opportunity wise. I mean, at some point, fingers crossed, we all hope there's some kind of resolution overseas between what's happening in Ukraine. So maybe as that settles down ultimately, what's going to be the reaction to governments or companies or other things as they kind of rebalance and rethink? I mean, it was a question that was posed to us that we wanted to address on the call. Will there be opportunity, or how should you think about investing, after everything is settled?
Sure. So I think that some things you have to consider are what areas or sort of what companies have sort of lost demand, and what companies can sort of shift that demand around. If you are a restaurant chain or that sells where people are coming to every day for whether it's breakfast, lunch, dinner, and now you no longer have those customers, it's not as though you're going to have people across the world increase their consumption to sort of make up for that. Whereas you have other companies where, say you're in the semiconductor space, where if your computer chips aren't going to a certain country, they can be diverted to another area of your production line, so that in some cases, some areas of your supply chain might actually improve. And you also look at it from, as we see what's happening now, what are the areas that governments might try to improve upon, whether it's, so we think could be opportunity within the IT space and cybersecurity, where we see a lot of not just companies but nations starting to say, hey, we need to get more serious about this, and that's something that we could see really moving forward.
And then when you look at the supply chain issues as well around what's happening either before COVID or now, I think you're to continue to have companies rethinking and have a little more domestic or diversified supply chain as well to help mitigate any future disruptions. So with that, as we kind of look at maybe a planning topic as we hit kind of the heaviest part of tax season the next month, one thing we want to talk about today is maybe maximizing your retirement or your IRA. As you're contributing overall, it's great to build up that tax-free income, but as you hit retirement and you get to the stage that's been extended now where minimum distributions that you're required to take out of your IRA now starts at 72. We want to talk a little bit about maybe considering looking at some different strategies that have been very effective for a lot of our families. And some of those are to look to increase or accelerate taking money out of IRAs sooner, even though you're not 72 at that point. And then other things are quarterly taxes. Quarterly taxes are a big issue. And there's a lot of effective strategies between considering paying your quarterly taxes or your tax estimates out of your IRA funds and some advantage around that. So David, I don't know if you want to highlight some of those.
Yeah, so as far as saving for retirement, and this is where financial planning really comes into play. But then the question is, what's my mix between the taxable portion of my portfolio and the non-taxable, or IRAs, 401ks? So as you start getting closer to retirement, if you think about it, your required minimum distributions are going to go up every year as you get 1 year older. And so what that could do is inadvertently push you into much higher required minimum distributions, which subsequently lead to higher tax brackets. So one of the things, as JR mentioned, is putting together a plan, especially before, after you retire, but before you start taking required minimum distributions, to reduce that number so that it doesn't impact and have those downstream impacts, whether it's Social Security being taxed or Medicare costs, et cetera. That's certainly one component. And then the second is being very diligent and kind of planning around using the required minimum distributions to offset and make some tax payments. So if that's money that needs to come out, you can coordinate and make sure that you're making the proper payments towards the end of the year, because it avoids you either underpaying and running into fees or fines, or overpaying and giving up some opportunity costs. So that's really a question for accountants, and we're happy to work with them to put together a plan for the families that we help. But there is a lot of opportunity to use that asset class to really make sure that you're getting the most out of your retirement funds that you've worked very hard to save for. So next time we meet, with anyone individually, it's definitely a conversation we should have.
With that, just to recap this month, I mean, it's been a difficult 2-year period. It's been a difficult month, and this year has been very volatile. And as the Fed has raised rates, there's starting to be a little more clarity and certainty. Obviously, we continue to watch everything that's happened overseas, hoping for a quick resolution overall. But as you look to the rest of the year, there's clearly opportunity in the markets right now, both stock and bond. Everything's kind of down at this point. Having said that, we're still remain pretty cautious on what's ahead and stay pretty patient. And then looking into April, we'll really get a sense as to what companies are seeing and what the impacts have been that'll help guide us the rest of the year. So with that, I want to thank everyone for listening, and we'll see you all next month.
Thank you, everybody.